You can hear the heartbeat in your ears. It is a rhythmic thumping sound that drowns out the logic of the market and replaces it with the raw, unadulterated adrenaline of survival. Just 48 hours ago, you were staring into the abyss. You were watching the red candles cascade down the screen like a waterfall of blood, taking your net worth, your confidence, and your sleep with them. You felt the cold grip of panic, the urge to capitulate, the sinking realization that perhaps you were wrong. But now, as the sun rises on this Wednesday morning, the world has inverted. The red has turned to green. The despair has turned to euphoria. The price of silver is not just recovering, it is surging. It is clawing its way back with a violence that matches the crash. It is reaching for $90, whispering promises of $100 by Friday, and begging you to believe that the danger has passed. But I'm here to tell you that the danger has not passed. In fact, the danger has simply changed its shape. Monday was a test of your stomach. Today is a test of your discipline. We are standing in the middle of a financial whipsaw, a volatility regime so aggressive, so mechanical, and so ruthless that it will chew up and spit out anyone who confuses a rebound with a recovery. What you are seeing on your screen is not a gentle return to normalcy. It is a face-ripping rally born from the ashes of a liquidation event. It is a market that is fighting for its life, thrashing around like a wounded animal. And if you are not careful, if you let the fear of missing out replace the fear of loss, you will be the one who gets hurt in the second act of this tragedy. We need to dissect this surge with the cold, clinical precision of a surgeon. We need to understand why the price is ripping higher, who is driving it, and why the $100 by Friday narrative is the most dangerous trap you can step into right now. This is not a time for celebration. This is a time for extreme caution. The market has shown you its hand. It has shown you that it can destroy value in the blink of an eye. Do not think that just because the arrow is pointing up today, the rules of the game have changed back in your favor. The game is still rigged, the leverage is still toxic, and the plumbing of the financial system is still leaking. Let us begin by analyzing the anatomy of this rebound. There is a fundamental difference between the way gold recovers and the way silver recovers, and understanding this distinction is the key to preserving your wealth. When gold bounces, it is usually driven by allocators. These are the pension funds, the sovereign wealth funds, the central banks, and the prudent individuals who are looking for a safe harbor in a storm. They buy gold because they want to park capital for 10 years. They are sticky money. They do not sell at the first sign of trouble. They are the bedrock of the bull market. But silver? Silver is different, especially right now. The surge we are seeing in silver this morning is not being driven primarily by allocators. It is being driven by speculators. It is being driven by the hot money, the fast money, the gamblers who saw the crash as a betting opportunity. They are chasing the momentum. They are looking for a quick 10% gain. They are not here for the revolution. They are here for the rip. And because they are speculators, they are fickle. They are weak hands disguised as strong buyers. If the price hits $95 in stalls, they will not hold. They will take their profits and run. And when they run, the air pocket underneath the price will open up again. And we could see another flush just as violent as the first one. This is the definition of a whipsaw market. It is a market designed to destroy both the bulls and the bears. It crashes to liquidate the leveraged longs, and then it rips to liquidate the leveraged shorts. It expands the range of volatility until nobody knows what the true price is anymore. In a whipsaw market, the price is not a signal of value. It is a measure of pain. Right now, the pain trade is higher. The shorts who got greedy on Monday are being squeezed. They are being forced to cover their positions as the price rockets back up. But once that short squeeze is exhausted, once the last bear has bought back his contract, who is left to buy? This brings us to the $100 by Friday narrative. It is a seductive headline. It is a round number. Humans love round numbers. We attach magical significance to them. We think that if silver hits $100, it validates everything. It proves we are geniuses. But round numbers are magnets for manipulation. The banks know you are watching that number. The algorithms are programmed to defend that number or to fade that number. If we run up to $99 in a straight line, driven by hype and FOMO, we are setting ourselves up for a double top or a blow-off top that could mark the end of this intermediate cycle. Do not chase the price. I repeat, do not chase the price. If you did not buy when there was blood in the streets on Monday, do not buy when there is confetti in the air on Wednesday. Investing is about buying value, not buying excitement. And right now, the excitement is overpriced. The danger of a Friday trap is real. Imagine the scenario. The price pumps all week, drawing in every last retail investor who thinks they missed the boat. Then, on Friday afternoon, when volume is thin, the whales step in and sell into the liquidity you provided. The price crashes into the weekend, leaving you trapped in a losing position with 2 days of anxiety ahead of you. This is a classic playbook. Do not fall for it. However, we must also acknowledge the valid reasons for this surge. It is not entirely smoke and mirrors. There are powerful fundamental drivers pushing the price higher, drivers that exist independently of the paper market games. The first is geopolitics. The world is a powder keg. Every day brings a new headline about escalating tensions in the Middle East, in Eastern Europe, in the South China Sea. Capital is frightened. Capital is looking for assets that do not have counterparty risk. When the missiles start flying, nobody wants to hold a bond that might be sanctioned or a currency that might be devalued. They want metal. This safe haven bid is real, and it puts a floor under the market that prevents it from going to zero. The second driver is the soft dollar. After the spike earlier in the week, the dollar has retreated slightly. The currency traders are realizing that the U.S. debt situation is untenable. They are realizing that higher for longer is a mathematical impossibility. The Fed will have to cut rates eventually, not because inflation is beaten, but because the government cannot afford the interest payments. This realization weakens the dollar and acts as a tailwind for precious metals. But be careful. The dollar is volatile too. One hawkish speech, one bad inflation print, and the dollar could spike again, acting as a wrecking ball for silver. The third, and perhaps most important driver, is the critical mineral narrative. We discussed this earlier in the week, but it bears repeating because it is the structural spine of the bull market. Governments around the world are waking up to the fact that they cannot build a modern economy or a modern military without silver. They are moving to classify it as a strategic asset. They are building stockpiles. This shifts the demand curve permanently. It introduces a buyer who is price insensitive. If the Pentagon needs silver for a torpedo, they will pay $100, $200, whatever it takes. This sovereign bid is fighting against the paper shorts, and eventually the sovereign bid will win. But we have to talk about the plumbing. The reason the crash happened on Monday was because of margin. The exchanges changed the rules. They raised the cost of holding a position. This forced the leverage out of the system. Now that the price is rising again, the leverage is creeping back in. Traders have short memories. They see the green candles and they forget the pain of 48 hours ago. They are re-leveraging. They are borrowing money to buy the dip. This makes the market fragile again. It builds a new glass floor. Furthermore, the market now has muscle memory. The participants have been traumatized. They have seen how fast the rug can be pulled. This means that at the first sign of weakness, they will stampede for the exits. They will not wait for the margin call. They will sell preemptively to avoid it. This creates a market that is jumpy, neurotic, and prone to sudden air pockets. We are in a regime where 10% moves in a single day are normal. If you cannot handle a 10% drop, you do not deserve a 10% gain. You must size your positions accordingly. The disconnect between the paper market and the physical market is widening during this rally. While the paper price whipsaws, the physical demand remains constant. The industrial users are not day trading. The solar panel factory manager does not look at the chart and say, "Oh, silver's up today, I guess I won't build panels." No, he has a production quota, he has a contract, he buys the metal. This inelastic demand is the true safety net. It means that no matter how much the bankers manipulate the paper price, there is a physical bid that must be filled. The metal must move from the vault to the factory, and there is not enough metal to go around. This scarcity is the ultimate truth. We are consuming silver faster than we can mine it. The mines are aging, the grades are falling, no new major deposits have been found in years, the supply cliff is approaching, and when we go over that cliff, when the industrial users realize that there is literally no silver to buy at the current price, the price discovery mechanism will break. The paper market will become irrelevant. The price will be set by physical possession. So how do you navigate this surge? How do you play the $100 by Friday game without getting burned? First, you have to define your identity. Are you a trader or an investor? If you are a trader, you are playing with fire. You need to have tight stops. You need to take profits aggressively. You need to watch the screen every second. This market is a sniper's alley. If you stick your head up for too long, you will get taken out. But if you are an investor, if you are a stacker, if you are holding for the generational wealth transfer, then this volatility is noise. It is sound and fury, signifying nothing. Your job is to ignore the hourly chart. Your job is to ignore the Friday target. Your job is to accumulate ounces when they are cheap and sit on your hands when they are expensive. Monday was a buying opportunity. Wednesday is a holding opportunity. Do not let the FOMO dictate your actions. The trap of the rebound is that it makes you complacent. It makes you think the storm is over. It makes you think the market has validated your genius. But the market is a cruel teacher. It often gives you a passing grade right before it fails you. The volatility we are seeing is a symptom of a broken system. A healthy market does not crash and surge like this. A healthy market discovers price efficiently. This is a chaotic market, a system in cardiac arrest, being shocked by defibrillators. We must also consider the Asian ambition. We have spoken about China's role, but it is critical to understand that their timeline is different from ours. They are not trying to push silver to $100 by Friday. They are trying to accumulate as much physical metal as possible over the next decade. They prefer lower prices. They prefer the smash. When the price surges like this, they step back. They stop buying. They wait. This removes a major source of demand from the market at higher levels. If the West pushes the price too high, too fast, without the support of the East, the rally will collapse under its own weight. The East is the whale. We are the minnows. We must swim in their wake, not try to lead them. The short squeeze dynamic is powerful, but it is temporary. Once the shorts are dead, the buying pressure evaporates. We need organic buying to sustain a rally. We need new money entering the space, not just old money covering debts. Are we seeing new money? Yes, we are seeing some. The retail public is waking up. But is it enough to sustain $100? Maybe, maybe not. The danger is assuming it is a guarantee. Let's talk about the psychological impact of hope. Hope is a dangerous emotion in investing. When you see the price rising, you hope it will recover your losses. You hope it will make you rich. You project your desires onto the chart. But the market does not care about your hope. It does not care about your mortgage. It goes where the liquidity is. Right now, the liquidity is higher, but tomorrow, the liquidity might be lower. You must replace hope with strategy. You must replace emotion with logic. The logic dictates that the fundamental thesis is stronger than ever, but the technical structure is broken. We are building a skyscraper on a swamp. The skyscraper is the silver price. The swamp is the leveraged paper market. The higher we build, the more unstable it becomes. Eventually, we need to drain the swamp. We need to move to a fully physical market, or at least a market with honest reserves. Until then, we are living in a construction zone where the ground is constantly shifting. As we approach Friday, the tension will build. The options market will come into play. The gamma exposure of the dealers will force them to hedge aggressively. If the price moves towards $100, they may have to buy futures to hedge their call options, which drives the price higher. This is the gamma squeeze. It can lead to explosive moves. But the opposite is also true. If the price starts to fall, they have to sell, exacerbating the drop. We're in the hands of the derivatives traders now. You must be prepared for anything. We could see $100, we could see $80. The range of outcomes is widened. This is not a market for the faint of heart. This is a market for the stoic, the person who knows what they own and why they own it. Do not let the surge blind you to the risks. The same banks that smashed the price on Monday are perfectly capable of smashing it again on Friday. They have deep pockets. They have the regulators in their back pocket. They have the media on speed dial. They can paint the tape. They can create a narrative. They can execute a rug pull whenever it suits their book. The only way to win against a rigged casino is to not play their game. Do not play the leverage game. Do not play the options game. Play the physical game. Play the possession game. When you hold the physical metal, you are immune to the margin call. You are immune to the flash crash. You are immune to the high-frequency algorithm. The price on the screen might change, but the weight in your hand does not. 1 ounce is always 1 ounce. This simple truth is your anchor in the storm. The storm is raging. The waves are high. The ship is tossing, but the anchor holds. As you watch the green candles today, enjoy them. Feel the relief. But do not let it turn into complacency. Stay vigilant. Keep your powder dry. There will be more dips. There will be more opportunities. The bull market is a marathon, not a sprint. We are in the early miles. Do not burn all your energy celebrating the first hill. The face-ripping rally is a gift to those who held. It is a punishment to those who sold. And it is a trap for those who chase. Which one will you be? The narrative of recovery is being spun by the media. They want you to believe the system is working, but the volatility proves the system is broken. A working system creates stability. A broken system creates chaos. We are profiting from the chaos, but we must respect it. Chaos is unpredictable. Chaos is dangerous. The allocators are watching this surge with skepticism. They are not chasing. They are waiting for the pullback. They are waiting for the retest. Technical analysis tells us that markets often retest the scene of the crime. We might go back down to test the lows of Monday. If we hold those lows, then we have a solid foundation. If we break them, we go lower. Do not assume the bottom is in just because we had one green day. The speculators are drunk on gains right now. They are high-fiving each other. They are posting rocket emojis. They are the liquidity for the smart money exit. When the smart money starts selling into this strength, the speculators will be left holding the bag. Do not be a speculator. Be an allocator. Think like a central bank. Think in decades, not days. The critical mineral aspect is the wild card. If a major government announces a new strategic reserve program this week, then all bets are off. We go vertical. We blow past $100 like it wasn't even there. But we cannot trade on rumors. We must trade on facts. The fact is that the market is tight, but it is also hysterical. Hysteria is not a strategy. Calm is a strategy. So look at the screen, acknowledge the surge, but do not let it control you. Do not let it dictate your emotions. You are the captain of your own ship. The market is the sea. You cannot control the sea, but you can control your sails. Trim your sails, batten down the hatches, and keep your eyes on the horizon, not the waves crashing over the bow. The destination is clear. The debasement of currency is inevitable. The rise of hard assets is inevitable. The path to get there is the only uncertainty. It will be a winding, treacherous path, but we will walk it together. The $100 by Friday headline is a question, not a promise. The answer depends on the battle between the physical reality and the paper fiction. The fiction is losing its grip, but it is not dead yet. It has one more fight left in it. It has one more trap to spring. Be ready for the trap. Be ready for the volatility. Be ready for the revolution. The surge is here. The game is on. But the whistle hasn't blown yet. Stay safe out there. Stay disciplined and keep stacking. The future belongs to the physical. The present belongs to the brave. Be brave, but don't be reckless. The line between the two is narrow, and the market is waiting to push you over it. Stand your ground.